and welcome to episode 35 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria and I currently attend the University of California, Los Angeles.
What we will cover today on the podcast is just a small part of what happened in the special situations world last week. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities such as our merger arbitrage tool, check out insidearbitrage.com. And please take a moment to like and subscribe to this podcast on whatever platform you might be listening on.
We are continuing with our new format this week by focusing on 5 key stories, including discussing the second largest acquisition of the year, a proposed spinoff by Keurig Dr Pepper, a massive $20 billion buyback announcement by Salesforce, and insider buying at Resideo, a company that was spun out of Honeywell quite some time ago and is now planning a spinoff of its own. Before we begin, we want to state that nothing on this podcast is meant as investment advice, so please refer to our full disclaimer at the end of this podcast.
Let's get things started with M&A, and this is not one of our key stories. It's more like an update from last week. Last week, we talked about Canada Goose, which is a luxury winter wear company that had received multiple buyout offers from interested parties, and the majority owner of Canada Goose, Bain, was supposedly interested in exiting its stake. We also mentioned that the company was going to be presenting at the Goldman Sachs retail conference last week. The company confirmed at the conference that they were not working on any take private deal or transaction at this point. What is interesting is that despite this denial, the stock actually went up last week, and it went up at a time when its fellow Canadian company, Lululemon, experienced a nearly 19% drop last Friday after same-store sales in the Americas declined 4%. Let's move on to another current deal update. There was another development in the $1.6 billion TaskUs go private deal where Blackstone was working with the co-founders of the company to take it private for $16.50 per share. Shareholders like Murchison felt that the deal undervalued TaskUs and the acquisition should be around $19 per share. Think Investments, another firm which owns 23% of TaskUs, also opposed the deal, and instead of $19 per share, they felt that the common stock was worth $25 per share. So last week, Institutional Shareholder Services, or ISS as it is more commonly known, agreed with both Murchison and Think Investments and recommended that shareholders reject the Blackstone deal. This is not something you see very often, that the shareholder services firms decide that they should vote against the deal. The stock is currently trading at $18.18, representing a negative spread of 9% compared to the deal price. So whether the deal finally works out at $19 or $25 or at the original $16.50 price, it seems like shareholders and investors who are watching this deal expect a higher price.
Moving on now to announced M&A news. Way back in episode 23, we discussed a pending deals in the works by TELUS Corporation, which was proposing to acquire all outstanding shares of TELUS International that it doesn't already own for $3.40 per share, payable in cash, TELUS Corporation common shares, or some combination of both. At that time, TELUS Corporation already owned 60.1% of TELUS International, so the deal already had majority approval, but TELUS International was trading at $3.61, 20 cents above the proposed deal price.
And why would that happen? Why would the stock be trading 20 cents above basically an offer that was already being made?
So often when a deal trades above the proposed price, despite majority shareholder approval, it's because minority shareholders are trying to squeeze out a little bit more from the acquirer, hoping that they might revise the deal price upwards, maybe even with the threat of a lawsuit. Granted, this doesn't always work. When Silver Lake Capital acquired Endeavor, the sports and entertainment company, the spread on the deal was a negative 20% at some point. However, that deal did end up closing at the agreed upon $27.50 per share price, So minority shareholders who had bought Endeavor stock above that price were left behind in the dust. But for anyone involved in the pre deal TELUS International deal, they definitely lucked out. This week, TELUS Corporation announced the acquisition of all outstanding shares of TELUS International that they didn't already own for $539 million, or $4.50 per share, payable in some combination of cash or stock. The spread on the deal is a mere 0.67% at this point, and the deal is expected to close in the fourth quarter of this year. And it's interesting to see just how much the deal price has been revised upwards from that initial $3.40 offer all the way up to $4.50. Mind you, TELUS International was trading somewhere in the $2 range prior to any mention of an acquisition.
Yeah, I mean, we've seen this play out a few times, going all the way back to Continental Resources and Harold Hamm. The minority shareholders in many of these situations have been able to squeeze out a little bit more. Even in the case like with Silver Lake and Endeavor, you can expect situations where somebody chose not to accept the acquisition price and they opted to go after the company in court to try to get a higher valuation. Switching gears to another announced deal, the second largest acquisition of the year was announced when Japan's Sumitomo Corporation, along with Apollo and Brookfield, decided to acquire the aircraft leasing company Air Lease Corporation in a deal valued at roughly $28 billion. The largest deal so far this year remains the acquisition of Union Pacific by Norfolk Southern, which came in at a whopping $85 billion. The two other deals that came close this year to this large air lease deal was the acquisition of Walgreens by Sycamore for nearly $24 billion, which closed about 10 days ago, and Palo Alto Networks' acquisition of identity software company CyberArk in a deal valued at $25 billion. Getting back to Air Lease, the deal is structured as an all-cash deal where the stockholders will receive $65 per share in cash, representing a premium of just about 8% from the stock's last close. Air Lease's market cap is under $8 billion, but the enterprise value is much higher because of the nearly $20 billion in net debt it has on its balance sheet. Usually, a lot of debt on the balance sheet could be viewed as a negative, but in this case, that debt is offset by the value of the aircraft this company holds and then leases out these aircraft to airlines like Delta, Allegiant, American Airlines, and Alaska in the US, all the way to Emirates and Etihad in the Middle East. Air Lease's background is actually quite fascinating. The company was founded by the godfather of leasing, Stephen Udvar-Hazy. I hope I didn't butcher that last name. He started his first aircraft leasing company as a student and spent decades competing with Tony Ryan, who was the founder of Europe's discount airline Ryanair. Tony Ryan had started an aircraft leasing company called Guinness Speed Aviation in 1975, almost a decade before Ryanair's first commercial flight. Basically, the company Guinness Speed Aviation collapsed in 1993 and it was broken up and later built as AerCap. Stephen's first leasing company, International Lease Finance Corporation, was sold to the insurance company AIG in 1990, but he remained in charge of the company. AerCap comes into the picture once again because it eventually bought his company from AIG after AIG ran into trouble during the Great Recession of 2008 and 2009.
So we've been talking a lot about AerCap. How did Air Lease eventually come to be?
Yeah, so Stephen tried to buy back International Lease Finance from AIG after it collapsed. Not completely collapsed. The government ended up taking a big stake in AIG. And as part of that whole process, AIG probably sold some assets. And so they sold that company to AerCap, and Stephen was trying to buy it at the same time. So when he was not successful buying his old company back, he essentially started Air Lease in 2010. While Air Lease is large and generated nearly $3 billion of revenue during the trailing 12 months, rival AerCap is much bigger with $7 billion in revenue over the last 12 months and has an enterprise value of $65 billion. Sumitomo, the Japanese corporation that wants to buy Air Lease, also owns another aircraft leasing company called SMBC Aviation Capital, which generated nearly $2 billion in revenue during the last 12 months. So the combined company, both Air Lease and SMBC Capital, will have about $5 billion in revenue and will still fall short of AerCap's $7 billion of revenue. And that might partially explain why the spread on the deal is just 2%. So it's possible that investors are not expecting that even though this could be a cross-border deal and so on and so forth, it might not run into trouble with the regulators. One of the reasons AerCap is so large is because it purchased GE's aircraft leasing business in 2021, just as Larry Culp was working to slim down GE by either spinning off or selling different divisions.
Yeah, that spinning off and selling divisions is what led to the creation of GE Healthcare and GE Vernova as well, and was all part of Larry Culp's big turnaround for GE after he came off a very successful tenure of leading Danaher.
Absolutely, and we've done well with GE because of that. We also had a position in AerCap for nearly 14 months in the model portfolio, and I owned it personally as well. But I ended up exiting that position earlier this year. While we made a profit on the position, we exited during the tariff fears of April, and that was a mistake in hindsight because the stock went on to perform quite well after our sale. These kind of businesses, AerCap and Air Lease, are highly cyclical in nature and can drop significantly during a downturn, which can often provide an opportunity to participate in the next recovery. And that could be one of the reasons I was thinking about an economic downturn being bad for this business, and one of the reasons I exited in April. But they both continue to execute quite well.
So we'll continue on to the spin-off section of the podcast. And as our viewers will soon see, a recurring theme throughout today's episode is food product companies. And what better way to start that than to talk about the proposed split up of Keurig Dr Pepper?
Is this just a split up like we saw with Kraft Heinz, or is there something more to this?
Yeah, so you're right. We're not just talking about a spin-off here. Keurig Dr Pepper announced earlier this week that they want to create a global coffee giant to rival both Nestle and Starbucks by acquiring JDE Peet's in an all-cash transaction worth about $18 billion. After the acquisition closes, KDP then plans to split itself into two independent, publicly traded companies, one being focused on the beverage market and the other set to become the world's #1 pure play coffee company.
So, considering they want to be the #1 pure play coffee company, how big are both these businesses likely to become?
Right, so upon separation, the coffee company is expected to have about $16 billion in combined annual net sales, making it once again the world's largest pure play coffee company. Its size should rival Nestle's coffee business, holding about 20% of the market share of the total global consumer packaged goods coffee market, reaching over 100 countries. On the other hand, the beverage business is expected to have about $11 billion in annual net sales and will operate in the overall $300 billion North American non-alcoholic beverage market, so has more of a local focus, whereas the coffee business is expected to go global.
So, what might be driving this acquisition and then the eventual split?
So there's a couple reasons that come to mind, starting with macro conditions as a whole. The transaction is expected to result in about $400 million in anticipated cost synergies, and also is expected to help the company weather rising US tariffs against coffee-producing nations and other trade rivals as well. See, this deal comes amid record high prices for global coffee due to droughts in top coffee bean producers like Brazil and Vietnam, and Donald Trump's recent decision to impose 50% duties on beans imported from Brazil. What's also interesting is that Keurig Dr Pepper was formerly known as Keurig Green Mountain and was in fact a pure play coffee company that was traded publicly from 1993 to 2015. It was eventually taken private by a group of investors led by JAB Holding Company in March 2016 for $13.9 billion in cash. 2 years after being taken private, Keurig Green Mountain acquired the Dr Pepper Snapple Group, a beverage company, in an $18.7 billion deal and was eventually taken public again. Now, JAB Holdings is a massive German firm that can trace its roots back to the 1800s, and it retained a major stake in the combined business, KDP, that has since been taken down to about 4.4%. JAB had also once taken Peet's Coffee private and still holds a majority stake in the business, totaling about 68%. Now, the synergies between the two businesses become a lot more clear with this JAB connection, and it could be that JAB is the one driving some of this change. JAB itself will hold nearly 5% in both of the follow-up companies after the acquisition and subsequent spinoff. Nevertheless, this situation does remind me quite a bit of the Kraft Heinz split up, which we'll tie back to later in this episode.
Switching gears a little bit to stock buybacks, Salesforce announced a massive $20 billion additional share repurchase, representing 8% of its market cap at announcements. For the last 3 years, they've actually announced $10 billion of buybacks in each of those years. And while a big chunk of those repurchases went towards offsetting shareholder dilution, they did manage to reduce their shares outstanding by 4% over the last 3 years. However, the big story last week wasn't their large buyback announcement, which was twice their normal amount, but the fact that Salesforce is cutting 4,000 jobs in its customer service department after deploying AI agents to do those jobs. Salesforce's founder and CEO, Mark Benioff, mentioned that he needed less heads. Benioff has in the past referred to Salesforce's employees as friends and family, and the whole company being one large ohana, taking the word out of the Hawaiian language.
Well, I guess at some point, certain concepts like ohana really do go out the window when AI comes to take over your jobs.
Getting back to Salesforce, this latest action in some sense reminds me of a comment by another Mark. Mark Andreessen, the founder of Netscape and the VC firm Andreessen Horowitz, once said that software was eating the world. I guess in some sense he was talking about the efficiencies and productivity gains from software, and especially enterprise SaaS software. In some ways, the same thing is happening with AI, and ironically, now people expect AI native companies to eat software companies instead. As we've discussed in the past, yes, this is very likely to happen, but enterprise software that is focused on a specific vertical might be harder to disrupt than a CRM company like Salesforce. This might be why Mark Benioff is trying to highlight the value of Salesforce's AI offerings and show how they're eating their own cooking by deploying AI agents instead of people for customer service. All that said, after several years of year-over-year declines in quarterly revenue, we saw some reacceleration last quarter with revenue growing almost 10%. They beat estimates on both the top and bottom lines. When I pulled up the stock chart, it was interesting to see that the stock had essentially gone nowhere over the last 5 years and is only up 4% during that time.
It's interesting that the stock has done a lot of nothing over the last couple of years, especially since there was a lot of brouhaha about Viva moving away from Salesforce CRM product and building their own, and then Salesforce actually being able to pull some of Viva's customers over to their side. And it looks like those small wins haven't done much for the overall performance, and I find that quite interesting.
And Viva Software is actually an excellent example of that vertically integrated software company that might be harder to disrupt than something like Salesforce, if you will.
Exactly. But transitioning over to insider purchases, one of the most fun things about doing this podcast or working with special situations in general is finding the intersection between different special situation strategies. This week, we saw yet another of these connections when we saw a series of insider purchases at the comfort and security products and solutions company, Resideo. Now, the name was first familiar to us since Resideo was spun out of the massive technology and manufacturing conglomerate Honeywell in 2018. As part of the spinoff, Resideo inherited the traditional home safety and security product solutions, including licensing products under the Honeywell Home brand, but also inherited the ADI Global Distribution business, a leading wholesale distributor of security and low voltage products for the commercial and then occasionally the residential market as well. As it stands today, Resideo has grown to partner with over 100,000 professional contractors, and their products and services can be found in over 150 million residential and commercial spaces globally.
So Resideo was a spin-off of Honeywell, which right now is undertaking its own spin-offs as well. Is there anything else that's interesting about Resideo, and why did we recognize this name recently?
Yeah, so the interesting part was that it wasn't just the Honeywell spin-offs that led us to recognize Resideo. It's that Resideo is set to spin off a business of its own. In July, the company announced that it would spin off the ADI Global Distribution business into a separate public company, with Resideo's products and solutions business left as a RemainCo to continue operating under the name Resideo.
So how do these two different segments of Resideo match up?
So Resideo's P&S business segment has lower revenues but higher margins. And on the other hand, the ADI business segment has higher revenues but has a much lower segment adjusted EBITDA margin. And part of the reason for the higher revenues in the ADI segment is the fact that Resideo had acquired Snap One, I believe, last year. And that acquisition ended up becoming part of the ADI business segment, which could explain why revenue is significantly higher, but then the margins fell as a result of the acquisition. Now, the other interesting bit about Resideo is the massive hit they took to their financial statements recently. So while the company recorded a new high revenue of $1.94 billion for the second quarter of 2025, they reported a net loss of $825 million for the quarter due to an $882 million expense they associated with the termination of the Honeywell indemnification agreement.
What's that, the Honeywell indemnification agreement?
So following the 2018 spinoff from Honeywell, Resideo also entered into an indemnification agreement with this parent company that comprised of annual reimbursement payments to Honeywell for certain environmental expenses incurred by Honeywell. So honestly, a lot of that was for Honeywell's benefit at the detriment of Resideo. The payments were capped at $140 million annually and extended until 2043, with an expense of $35 million incurred each quarter as the payment was sent to Honeywell. Now, in order to execute the separation between the ADI and Resideo business, as well as to increase strategic and financial flexibility, Resideo decided a few weeks ago to make a one-time cash payment to Honeywell for $1.59 billion to eliminate any ongoing or continued payments. This is equivalent to about 11 years of payments in aggregate, which saves the company about 7 years of payments because until 2043, about 18 years remain.
Yeah, but at the same time, we also have to keep in mind the cost of capital to Resideo for that 1.59 billion. I think their debt, the last debt that was priced 2% over SOFR is a little over 7%. So they save, over the entire period, maybe $200 to $400 million, which is not chump change, but it certainly is going to help their earnings going forward. Is that one of the reasons we've been seeing insider buying in the stock recently?
Yeah, those cost savings could be a possible reason. And the strange bit is that Resideo's stock price has run up by about 100% in the last year alone. And the insiders have bought all the way up thus far. The typical pattern is that we see insiders purchase shares after a drop in the stock price, not
Yes.
after this company continues to run its stock price up and up. We saw this week insider purchases by the company's chairman, who has served on the board since shortly after the Honeywell spinoff, and by the 10% owner, CD&R. CD&R is one of the world's largest and oldest PE firms, founded as Clayton, Dubilier, and Rice in 1978. And as of their last 13F filing, so in the present, the firm has over $82 billion in AUM, and the industries that CD&R invests in are quite diverse, spanning industrial, healthcare, consumer, the occasional technology, and financial services and markets. CD&R invested in Resideo in 2021, so a few years post the Honeywell spinoff, and they could be a factor in pushing for a separation of the business, much like how Elliott has been urging Honeywell itself to spin off its various businesses in a similar fashion to GE. CD&R does have an excellent track record when it comes to managing businesses. They recently sold Foundation Building Materials, FBM, a leading distributor of interior building products, to Lowe's companies for $8.8 billion, and under their ownership, along with American Securities, FBM experienced a period of exceptional growth, resulting in 27% annual revenue growth and 31% annual EBITDA growth. So this firm definitely knows how to manage businesses, and we'll see how they continue to work with their Resideo investment going forward.
Yeah, that's excellent stewardship. And it's interesting to see all these companies, whether it's Lowe's or Home Depot, buying up all these construction product companies, along with Brad Jacobs throwing his hat in the ring, trying to build a roll-up of construction companies.
Exactly. Anytime I see these building products or construction companies, I'm reminded of Brad Jacobs and QXO. and GMS and Home Depot, which I believe closed this week or last.
So, switching gears now to C-suite transitions, there was not a whole lot going on. Usually, we see several dozen appointments and departures, but this last week was a little slow. One executive departure that caught my attention last week was the departure of WillScot CEO Brad Schultz. The name is familiar to us because of this mobile storage company's failed attempt to acquire McGrath RentCorp in 2024. After nearly 9 months of trying to get the deal through regulatory logjam, the company finally gave up as the process of working with the FTC to get the deal cleared was proving to be a distraction from running their business. And they stated as much in a press release when they announced the termination of that merger. Brad has been with Bill Scott for nearly 8 years and will step down by the end of this year. He oversaw the company's highly profitable acquisition of Mobile Mini and then the subsequent failure to complete a deal for McGrath.
So, how has the business performed since this failure?
Yeah, one thing we look for in deal failures is we will look for either the target company or the acquiring company's stock to drop a lot and to see if maybe that makes for an attractive entry point post failure. And we did do that with Will Scott as well. I think we wrote about them. If I'm not mistaken, they probably announced a large buyback at that point. So, as is often the case, we did see a big drop in Will Scott after the deal failed. But I'm glad we held off on starting a position because Will Scott has not been able to stop its decline in revenue and has missed earnings estimates for the last 2 quarters. The company promoted its president and COO, Timothy Boswell, to take over the top role as CEO. He has been with Will Scott for 10 years and was also the company's CFO for most of those 10 years. Considering this is a solid business that is facing some macro headwinds, this internal promotion makes a lot of sense, and it'll be interesting to see if Mr. Boswell can get the company back on track to start growing again. This is the business where if you see a lot of construction going on, their mobile units are often at the construction site, or if a school needs a temporary classroom, you'll see one of their little units on the school grounds. Considering the macro issues that they're facing on the construction side, I don't think it's an execution issue at the company as much as getting through those headwinds and getting back to growth.
It looks like the company is aiming for internal promotions and it changed from the internal side of things. But we can transition over to the activist section of the podcast, where we're seeing change come in from the outside. We mentioned Elliot earlier in connection to Honeywell, and quite frankly, it's been some time since we last brought up the activists. However, this week, Elliot disclosed a whopping $4 billion stake in the beverage giant PepsiCo and called for a turnaround at the business, as is their usual playbook. Elliot's stake represents only about 2% of PepsiCo's total market value, but it does make it one of the firm's larger holdings. The firm also called out Pepsi's North American beverages unit as an underperformer, claiming its growth and margins lag behind peers like Coca-Cola due to strategic missteps, market share losses in soda, and the introduction of distracting new brands and products. Elliott also suggested that the company evaluate re-franchising its bottling network, much like Coca-Cola, and this means they would sell the rights to distribute their drinks to regional bottlers and keep equity stakes in those franchises. The firm also suggested an outright spin-off of the North American bottling business.
So yeah, when I saw the Elliott announcement, I found it fascinating that at some point or the other, these two companies, Coca-Cola and PepsiCo, are either spinning off their bottling business or they're buying them back. I guess it makes money for the investment bankers for sure.
So that point about the bottling business really highlights the fact that PepsiCo is not just a beverages company. There's a lot more to the business and all the different business segments that they have. So Pepsi also has a major packaged food business segment. And Elliott has actually encouraged the sale of non-core assets on that front, including the Quaker Food and Quaker Oats business.
So how does this compare to, for example, the Kraft Heinz split up that you were talking about? Do you see any connection between the two?
In some sense, yes, and it also reminds me of the KDP split up and acquisition that we just mentioned earlier. So in their letter, Elliott had claimed that the disappointing performance of PepsiCo's beverage business had traditionally been offset by this resilient and high-performing foods business, PepsiCo Foods North America, or PFNA. But that segment has begun to falter recently. Now, PFNA, the foods business, and the beverages business each usually contribute about 30% of annual revenue, and the company has really been striving to build out the beverages side of the business. They built a 5% stake in the energy drink maker Celsius last week. The acquisition of the prebiotic soda brand Poppi a few months ago for about $2 billion also made major news headlines. Now, in terms of the connection to Kraft Heinz, and again, in some sense, KDP as well, we're seeing a split up and consolidation in many of these traditional packaged food businesses and beverage businesses as well. So there's a lot of common themes at play here. There's rising costs due to tariff concerns, consumers pivoting from packaged foods to more healthy options, as is a trend that we've been seeing across grocery stores in North America. We also have things coming in from the regulatory side of things. Donald Trump and RFK Jr.'s MAHA, or Make America Healthy Again movement, and more. All this could be contributing factors to the decision to separate these massive food and beverage conglomerates and focus on the key products, or even the higher margin and better selling products, rather than diversifying and trying to capture as much market share as possible. And with that, we will wrap up episode 35 of the Special Situations Report. What we've covered today, as always, is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities such as the merger arbitrage tool, check out insidearbitrage.com.
And if you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast is a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of capital. You should conduct your own research and due diligence before making any investment decisions.